fundsupermart.com.
Hi, what is the outlook for US equity market going forward given that 2013 saw such a fantastic performance? What will be the drivers and detractors to the performance over the coming years?
Absolutely. So as you referenced, 2013 with a little bit more than 32% in the S&P 500 index was really an outstanding year. For us, the outlook is still quite positive for the year 2014, and it would highlight perhaps three different areas in that regard. First of all, we do expect that the economy is still growing quite strongly. The expectation for 2013 shows a real GDP growth of roughly 3%, which obviously is much more stronger than other developed markets. And therefore, we really see a push from the US economy, helping the consumers, helping companies, and obviously helping equity markets as a result. Secondly, we do foresee that the consumer is much more balanced for this year. We've been seeing a lot of deleveraging over the last couple of years. And really, with the unemployment rate coming down, people finding more jobs, that's quite helpful for the overall prosperous US consumers overall. As you know, the US consumer is making up about 2/3 in terms of the GDP contribution, and therefore it's critically important that the consumer is on board. And then thirdly, I would say that corporate earnings have come in really strongly. So if you look back to 2009, since then, corporate earnings have more than doubled, measured by the S&P 500 index. And therefore, the equity markets, which have been rallying over the last years, actually we know up to the end of last year by about 170% compared to back in March 2009. That has mainly been driven by corporate earnings. So our outlook for this year, again, for the earnings picture is roughly 8 to 9% in terms of earnings per share growth. On top of that, roughly 2% dividend yields. So our expectation is for lower double-digit performance for this year for US equities, which should hopefully be helping investors overall.
There were little differences in performance between the larger cap and the smaller cap indices in the US in 2013. The S&P 500 delivered a total return of 32%, while the Russell 2000 returned 38%. Do you think 2014 will be more differentiated returns between the larger and smaller cap companies? And how would you advise investors to position the equity portfolio?
Yeah, so our expectation for this year is that the large cap names are probably a little bit more interesting than smaller caps. In our global multi-asset portfolios, we have been seeing a trend whereby portfolio managers have been favoring the more larger cap companies. The main reason for that is that valuations look more attractive in the larger cap space. Small caps have been rallying, as you referenced, but that gave them a valuation which is now getting very close to 20 times forward PE, while the larger cap universe, S&P 500, is closer to 15 times PE. So our expectation for this year is that with all the growth we've been seeing domestically in the US, obviously small caps will be performing. But given the valuation discrepancy between large and small caps, we have a small preference for larger cap names at this point in time. Having said so, however, we are more focusing on companies in the larger cap universe which are more domestically orientated. So again, feeling that the US economy is growing a lot, we do foresee that companies are benefiting a lot from that particular trend. While on the flip side, the more multinational companies having lots of exposures towards Europe, towards emerging markets, will probably be still a little bit more challenged as the growth trends are less clear to us at this point in time than the US domestic business.
There has been much talk over the expectation of rising interest rates and the Fed tapering. What are your views on these issues and how would they affect investments in US equities?
Yeah, so we do foresee that Fed tapering will be continuing in the same pace as we currently see it. So no big surprises from that particular area. And we do feel that this is quite a positive trend because if the Fed feels that the economy is self-sustaining, that's obviously something whereby we do foresee that equities longer term will be benefiting as well. Reasons for that is that equities normally are looking forward. What are the new growth trends? Where is economic momentum coming from? And we do foresee that those two areas are quite nicely working together. So from that point of view, no concerns to that particular regard. It's more positive because it really underpins the economic growth perspective of the US economy.